Hi and welcome to Your Finance TV. We're here with Jeffrey Huge, founder at Alpha Insights. I nearly stumbled my words there. So Jeff publishes weekly playbook on Sunday night, which is available on Substack at hugeinsights.substack.com. Jeff, welcome back.
Great to be here, Mehdi. Thanks for having me on the show.
So before we dive in, I better throw in a plug for us as well. Make sure you like and subscribe to Your Finance TV to stay on top of all of our content as well. But without further ado, Jeff, I'd like to kick off as usual with the top down.
Yeah, the S&P had a pretty good week last week, but most of it came in the last couple of days with some big earnings reports. Uh, you know, I guess importantly and notably, Meta, which was up some 20%, on the news. And it's a pretty big heavyweight. It's like the number seven, might be the number six play now in the Magnificent Seven, which is being winnowed down to maybe something less than that. We'll talk about it in a bit, but we had some big earnings from these companies, and I think Amazon had a nice quarter as well, and I think Google was probably the sore spot last week, and I guess if we take a look at what's happening internally within the market, it's still a handful of stocks that are really driving the performance, and it's really four to be precise. And I think from the standpoint of the average stock, I think we're down in the month of January and flat for the year. So the S&P equal weight index has made zero progress this year, despite enormous gains out of companies like Nvidia up 40% or Meta up 30% year to date. So there's quite a bifurcation in contribution. We continue to be a little skeptical of the market. I think this narrow breadth is something that one would expect to reveal itself like this toward the end of a major advance. Bob Farrell's old rule number seven comes to mind. Bull markets are strongest when they're broad and weakest when they're winnowed down to a handful of blue chips. And I think we can call, the Magnificent Seven the blue chips of our day. That being said, we've got another big week of earnings. There's four Dow stocks reporting to yesterday with Cat McDonald's. I think we also have Disney to look forward to and Amgen. Not to mention another 100 odd stocks that are reporting this week. We've got 12 Fed speakers this week. That's got to be a new record as far as I'm concerned. That's every Fed president. And Powell did a 60 Minutes interview just to reiterate what he said went last Wednesday, that, hey, we're not going to cut in March, get that through your thick skulls, Wall Street, as nicely as he could. And I think the market is starting to kind of wake up to the notion that, okay, maybe we're going to be seeing fewer cuts, and maybe those cuts are going to be coming later than expected. Last I looked, and this is constant change, but I think it had been trimmed down to just five cuts for the year from six, with the first one kicking off in May. But a lot could happen overnight. I haven't checked it this morning, so I could be wrong about that. That being said, where would we position ourselves? How would we advise our clients to position? Look, we're long short sort of traders. We like to find stocks that are going up and get long, and short stocks that are going down and balance our risks that way. And so we continue to expect the market to be more of a stock pickers market, and we think less net exposure to the index or more of a market neutral approach seems to be what's going to produce the most alpha in our minds. We also continue to like T-bills at 5.5%. How can you go wrong with a 3-month T-bill at 5.5% right now, when your other alternatives is to buy 10-year treasuries, which are all over the place? So those are our two best ideas. If I had to throw a third one in there, I would say hard money, gold. That's a place that we want to be. Bitcoin, no, we think it's in a void. We think Bitcoin's going south. And, we hear a lot of Bitcoin advocates out there talking about the halving and looking at the past two or three of those and how it made such a difference. I don't think that had anything to do with it, and I don't think it's gonna have anything to do with it. The ETF creates the opposite condition of the scarcity value that is inherent in Bitcoin. In fact, the ETF eliminates most of the benefits that Bitcoin has as kind of a decentralized currency. You've now reattached it to Wall Street. And instead of trading 24/7, it trades market hours now. I think that's a real disadvantage. I don't think the ETF has really opened up the market for Bitcoin. I think it's actually shut it down. And in my opinion, look, Bitcoin really doesn't do much, and the futures market means that it's unlimited. You can have an unlimited amount of Bitcoin out there now in the futures market, just like in the gold and silver market. That's really what's hampered that, commodities ability to go much, much higher is this constant supply created in the futures market. And so we do like gold. We do think hard money is something to focus on for what we think is coming, which is going to be a recession in 2024 and a major earnings drawdown of at least 15%. So with that said, let's go forward with any questions you might have.
So Jeff, you just first of all, thanks for the recap, but also you ended your statement with like a look at how these earnings are all going to play out. And as you mentioned, we are in the thick of earnings season, Q4 earnings seasons at this point. Outside of the Magnificent Seven, how are things looking this far, or thus far, I should say?
Yeah. Overall, I would say the numbers are coming in line with the dramatically lowered expectations. If we took a look at what fourth quarter earnings estimates were on September 30th of last year versus where they were on December 31st, they were down about 9 percentage points. Okay. So we're coming in basically in line with that December 31st expectation now, give or take. There have been some notable beats and some notable misses. On the beat side, obviously, communications comes to mind. We saw a big beat with Meta. In tech, we've seen, a couple of upside surprises. Tech's coming in better than expected to the tune of around 4%. I think Commas 3%. Consumer discretionary, we've seen a lot of upside surprises there. It's coming in about 7 percentage points above expectations. And healthcare is up about 3% over expectations. The real weak spot in the market right now is financials. Financials, utilities, a couple other, minor sectors have just de minimis sort of misses, but financials were 15% below expectations. And it wasn't just New York City or New York Community Bank Corp that is responsible for that. That's part of it, but not even a S&P 500 company. So, S&P 500 earnings are really missing badly on the financials. And I think that speaks to a cavern of weakness that is building up in the market. You can't have a market continue to have a sustainable bull market without financials participating.
So, excuse me, while financials are obviously on the weaker side, technology has been a complete flip of that. It's kind of a runaway sector. The information technology sector certainly has had a nice run. But it's starting to look a little bit overextended here. What are your thoughts on this?
Those are my thoughts. The S&P information technology sector is now 30% of the S&P's overall market cap. That is the highest relevance that tech has had within the index ever in the history of the index. I mean, 30% is it. I think back during the dot-com bubble, it got to around 27%. But 30% is really significant. Probably the more significant thing is the fact that if we look at the ratio of the information technology sector to the S&P 500, it's now, ascending to new all-time record extremes, exceeding even what we saw during the dot-com bubble back in 2000. And, this is all happening largely since October 27th. There's a near vertical move up. I think that is an unsustainable move. And it really makes me wonder whether we're not putting in at least a local top in terms of tech's significance in the overall scheme of things, if not a major top.
Well, so okay, so then on that point, let's have a look at investor sentiment. Like, how is sentiment tying into this? Because everyone seems quite happy at this point.
And they always are at the top, aren't they? We keep looking for and keep finding more and more evidence to support our view that sentiment has reached a new crescendo, if you will, a new all-time bullish extreme. And the latest survey data that we found that confirms this comes from Consensus Inc. Consensus Inc. Has seen a new 5-year high in overall investor sentiment. And it's only 1% below the all time high. So we're at 77%, the all time high, 78% bulls. And, from our lens, when we look at this long term monthly measure of the consensus data going back almost 20 years, we can't find a period where we get to these levels and it's been a positive for stocks. In fact, last time we were even near these levels was around 2018, and that's when the market really started to chop. And then, of course, we did get to a modest new high, 10% above the prior high in 2018, but then we had a 38% collapse in the S&P 500 when the COVID crisis occurred. The market was just set up for a fall, and I think that's where we are today in the same sentiment environment. Everybody's all in, everybody's complacent, and nobody's managing their risk appropriately, as evidenced by the fact that tech is 30% of the S&P 500.
That's a fair point. So let's have a look at some technicals here, Jeff. I'd like to kick off with the preferred Elliott wave count, please.
Yeah. So as we've been saying for a couple of weeks now, since we broke out to new all-time high, we adjusted our preferred count to reflect the notion that we're in a fifth wave of a fifth wave. So the new count suggests that we're in the final subdivisions of primary wave 5, of cycle wave 5, and by extension, super cycle wave 3. Within that process, we have pushed north of the target price that would have been a perfect target for the S&P, 49.40, where the S&P's primary wave 5 would have been 2.618 times primary wave 1, a very common wave relationship. And so that, push above 49.40 to a new high of 49.75 is about 35 handles beyond that target, but it's less than 1%. That, in my opinion, is an acceptable margin of error for that target, and especially considering where we are, right, in the context of sentiment and other things. So we think we're at the terminal phase. We think we're at, the final subdivisions, be it minor wave 5, of intermediate wave 5, of primary wave 5, to end cycle wave 5 and terminate super cycle wave 3. So what comes next? What follows is not good news. It's super cycle wave 4, which will be a large degree, multi-year, if not decade-long corrective waveform to correct a 90-year advance that began all the way back in 1932 and terminated this January. If we're correct about that very, very big picture, we think that the corrective process over the next decade could carry the S&P down to incomprehensible levels for the bulls. We're not going to throw a target out there, but we think that the bulls will be eviscerated in this decline, and anyone who continues to try and buy the dip, so to speak, we think the decline will be utterly merciless.
Ouch. Well, merciless is, when you end a statement like that, it always gets me revved up. So let's go back to the merciful, the Magnificent Seven. I know you touched on them in your opening statements, but yeah, as you said, there seems to be, obviously a bit of a bifurcation between Magnificent Seven members as well. Are we going to end up with something like the famous five along the way?
I would say the fabulous four.
Oh, we're
And
down
why
to
do I
four.
say that? Yeah, if you take a look at the year-to-date performance of the Mag Seven, Tesla's down 27%. It's the worst performer, of course. And we've heard some, vocal media pundits suggested it should be kicked out and replaced with AMD or something, just to keep that, trademark Mag 7 name going. I think the next bear market will eliminate all these, nicknames that we have for these groups of stocks. I mean, that'll just kind of go by the wayside. But Apple's another one that's failed to participate. It's down 2.5% year to date. And Google, I think, is up like 3%, but it's underperforming the S&P 500. And those three stocks really look like they could, fall by the wayside. Certainly Tesla and Apple, albeit we've just seen them grow for the first time in a year. It came at a large expense. I mean, they're experiencing significant declines geographically, especially China. We are not seeing anything, remotely innovative in the iPhone that would, prompt someone like myself to upgrade my iPhone 11 to whatever the latest generation is. I guess the 14 or 15 or something. But I mean, I've had the same iPhone for, gosh, almost 5 years now. So, I don't see any reason to change. It works great. I've never had a problem with it. So, I like the case that I have. I don't want to change the case, and I know the form factor is changing. So all these things together, I think, still are running together for Apple. And the new Ocular, their new endeavor into virtual reality with their goggles. That looks like it's a long way off from becoming mainstream, especially at a price point of 3,500. But I think that the early reviews are that this is kind of a weird thing that messes with your head, and you get dizzy after you use it, and people are having vision problems and everything else. And the financial media swept that under the rug. But if you dig a little bit deeper, there's a lot of criticism about this device, and the same as could be said about what Meta is doing. But anyways, you do have NVIDIA, Meta, Microsoft, and Amazon. One of the things that concerns me most is a lot of these business models have an advertising component to them. And if we do go into recession, I think advertising will come under a lot of pressure. Companies cut their ad budgets by 50% during recessions. And it's because they know that they're wasting their money on advertising. They know they're wasting half their money, even in a bull market, even in a growth period. They just don't know which half. So they just cut it, across the board. And so I think, we're going to see a lot of pressure on these, click-through rates, and companies like, Google and Amazon and Microsoft to a lesser extent, and Meta. They all have big advertising components. I think those are at risk for later in the year and next year. But the picks and shovels side of the business, the NVIDIA, AI chip side, that might have some legs. I think Druckenmiller kind of pointed out in a conference a few months back that take a look at Cisco. Cisco had a 4 or 5 year bull market. It was the nuts and bolts of the internet. If NVIDIA's chips are the nuts and bolts of AI, you could have a multi-year bull market. Okay, so I think it's pretty overextended right now. I think that they'll probably put up a good quarter when they report on February 21st. Their November quarter was outstanding. And it got the stock to break out, but the initial reaction was not a blowout. The initial reaction was sideways, chop, and then it built a base and broke out again. And I think that we're going to see more of that. We're going to see some of these stocks just kind of build bases for a while. And as they do, they can then break out further. And so, we've traded NVIDIA twice now. And at both times, we made our target and we made good money, but the stock just kept going. And so, I think you got to give these stocks a little bit more latitude, certainly than we have. But I think some of them can work. And so I would stick with the NVIDIAs of the world. Meta is obviously a stock that's performing well. Their business model has changed. They've cut expenses to the nap. They've rerouted their emphasis away from the metaverse, which I think a lot of people had problems with. I don't really know anything about Meta. I don't use it. I'm not a big technophile, if you will. But I recognize the performance of the stock has more potential. And then, I do love Amazon. It's a stock that we own, but I consider myself an uninformed investor. We're more traders around it. And, I would say that, Amazon's business model is going to be very, cloud centric. That's really what's driving it, not the retail side. Certainly there's an up and coming AI potential there as well that a lot of people are betting on. And then finally, Microsoft, I think, is kind of the crown jewel of AI. And I think that they will be within a leadership spot there as well. So those are the four names that I would call the Fab Four, and the other three I think are kind of at the margin. We have to wonder whether they're going to continue to perform. We'll see. Time will tell. They're
Fab
on
Four,
watch.
the Fab Four it is, and we'll definitely be keeping an eye on them. So obviously, there's an impact, an outsized impact, almost from some of these names like the Amazons of the world. But let's have a look at the sector kind of performance. There's been a bit of a shakeup here over the last several weeks. How are things looking from a sector view?
Yeah. So from a sector view, last week, obviously, com and techno or discretionary rather were the big winners because of Amazon and and also because of Meta. Okay, those two stocks had unbelievable earnings reports. Like I said at the outset, I think Amazon, or I think Meta's up 30%. Amazon, I think, is only up maybe 15 or 18%, something like that. Nvidia is the other big winner, up 40%. But even with Nvidia up 40% year to date, last week tech barely managed to register a positive return. I mean, it was up a quarter of a percent, basically unch. And if we take a look at what's outperforming the S&P 500, staples, healthcare, both up a couple of percent last week. So you've got kind of this mixed bag here, where you've got a couple of big, you know, leadership plays, right, that are being driven by the Fab Four. But then you've also got some defensives coming up, and honestly, I wouldn't rule out energy at this point. Energy looks like it might be starting to bottom here. Certainly, from a valuation perspective, it looks very, very cheap. But in terms of last week's contribution, it just wasn't there.
Yeah, energy is a very strange one right now, isn't it? It's the fact that we've got all this geopolitical stuff situation going on, and we're not seeing any breakout in crude at all either.
Hmm.
So a strange spot to be in right now, but maybe this consolidation will see some more strength come out of that soon. Jeff, right, so that all being said, what do we do? How would you best look to position yourself from a sector basis?
Well, let's start on that energy topic again. So, like I said, it's the cheapest sector in the S&P 500. So it gives you a great margin for error, right? A margin of safety, if you will, in terms of valuations. Maybe what um, the fact that crude oil isn't performing despite all this geopolitical tension. Maybe the message that's being forecasted here is that we're in for global recession. That's the way we've interpreted this lack of demand. I think all of the performance from energy is going to come from the supply side, right? I think that we're going to continue to see supply cuts out of the Middle East, either because OPEC decides that they don't like the price below $80 a barrel, and that's where they needed to, maintain stability in the region, or because Iran and their proxies have decided that they want to disrupt, the distribution of crude from, the Persian Gulf. Okay, and that's certainly something that's been a problem in recent weeks. There's a recent episode of a ballistic missile being fired at an oil tanker. So this is happening, and so all these things together, suggest to me that we could see higher oil prices based on supply constraints, not because demand is so strong. Now, U.S. production is now maxed out, right, at its all-time record high. There's a little bit more capacity in the U.S., but even guys like the chairman of the board of Chevron was on CNBC a week ago saying, we're operating at like 99% efficiency. So there's a little bit more, but not much. And we can't just flip a switch, right? It's going to take time to ramp it up. And so I don't think U.S. production is going to fill that gap. And I do think we will see higher crude prices for all the reasons stated. And with that, I think the energy patch will perform better. I think its relative strength appears to be bottoming and starting to turn up right now. And I think because of that, I want to pay close attention to it. That being said, where I'd position myself today is healthcare and industrials. These are two sectors that are actually starting to see a reversal in the momentum of the relative strength, and I think we're seeing some earnings performance there. Not so much on the industrials. I think it's coming in a little bit better, but nothing really material. But healthcare is posting 3% better than expected earnings, and that should help support this shift in relative strength momentum that we're seeing. We've already seen both of these move back into the leading quadrant, and once they pass in the improving quadrant, once they pass through the leading quadrant, we can have a lot more confidence about that. But these are two sectors I want to focus on. And then, I think comm continues to be pretty strong, and it's rotating back toward the leading sector. What's at risk here, I think, is tech, financials, and REITs, especially financials and REITs. I think there's a lot of risk there. But tech continues to look vulnerable as well, and it's possible that we get a really good report out of Nvidia, but the stock's already priced it all in, and the stock chops or gives up some, and that could contribute to that. And so I would be aware that that's certainly a possibility and manage risk around it.
Fantastic. We'll take the base hits. Jeff, as always, appreciate your thoughts from Alpha Insights.
Always a pleasure, Mehdi.
And I want to thank our viewers and make sure you check out Jeff's content, and it's available on Substack at hugeinsights.substack.com. Until next time, thank you for watching and good luck investing.